Two dividend stocks to consider in February of 2024. This is a series that I do every month. I did one in January. I talked about two stocks. The first one was PepsiCo. And I mean, it's been doing fine. And dividend, I believe, is for safe. I still think it's undervalued. The second one I talked about, it was a microcap stock that I sometimes share them with you guys on YouTube. If they're above 100 million market cap, because if they're below 100 million market cap, I tend to keep them for my own, group. I don't share them on YouTube, but this stock is decisive dividend. I mean, it's up pretty good year to date, around 22% from the value. I think it's up 19 or 20% for the months. I mean, it's still extremely undervalued. The dividend is still safe and the company is still growing. So these two stocks, I still believe both of them are somewhat undervalued. I also talked about Pfizer in my last video of, something like cheap stocks or whatever. And I still believe Pfizer is a good dividend. And I believe for the most part, the dividend is safe, even though it's not the best, high quality dividend stocks that you want to hold for the very long term, which is why I made this video today to discuss these two stocks. Both of them are REITs. I think they are very safe. The dividend is over 4%, good payout ratio, like 70, 75%, some of them around 65%. So it's a pretty good payout ratio. I think these companies have a good dividend. They have some growth ahead in terms of FFO per share, and they also have a potential multiple expansion once we see interest rates come down in the future. They're eventually going to come down, and once they do come down, these stocks could make massive moves, but you could collect a 4 or 5% dividend yield in the meantime to get paid while you wait. So these are the two stocks. I've talked about them before, but I mean, they haven't really played out, which is why I decided to do this video and talk about them again. Now, the first stock is a stock called AVB, which is Avalon Bay Communities. I initially talked about this stock when it was around $159, $160 per. This is when I bought it, $157.59. This is when I bought it. Then it went up around 23%. I sold it around $185. Then I took the profits and I bought the second stock with it that I'm going to talk about. And I still own the stock and I'm down on the position. But that's how it is sometimes. You can't be right on everything and you can't be positive on everything. So Avalon Bay Communities is an apartment REIT in the United States. They own many different apartments in many different states, of course, mainly in New York, California, Washington State. Over 85% of the revenues, it comes from these blue areas. But they have been recently starting to dispose a lot of their properties, around 4 dispositions in California, New York, and these states, and they are trying to expand in the Sunbelt area, in Texas, in Florida, and many different states, North Carolina, some South Carolina and stuff. And the key is that this is where people are moving to. They're moving from New York and California, where Avalon makes 85% of the revenues, and they are moving to Texas and Florida. And this is what the company is trying to do. But this is their exposure, and they've been trying to work on it and expand in different areas. They have many different things that have been pretty promising. This is an innovative company. It's just not an apartment REIT. They have the apartments and then they lease them and that's it. They have different things they're working on. Like there's something called Avalon Connect. They kind of partner with some company to give them high-speed internet. They had a 6 million initial projections. They made 10 million. The second one is pretty much renting furnished apartments if people want them with furniture. Instead of 1 million, they made 2. Another one, they have some kind of labor efficiencies. They're trying to use AI and many different systems to, some systems to save on labor. So instead of 5 million, they made 7 million. So it's a pretty innovative company. They do many different things. But one thing that has been very upsetting as of the last earnings report, which was not long ago, it was this week, it was mainly the guidance for 2024. FFO per share growth is projected to be around 1.4%. Now, this has been disappointing to the market a little bit. It has not been disappointing to me. I'm going to show you exactly why. But 1.4% and rental revenue growth only 2.6%. These companies have been increasing revenues 7 and 8 and 10% after 2020. But this is, to me, this is my thesis, is that this is just a reversion to the mean. You go up and then you go down, then you stabilize, then you start increasing again. This is just a cycle, and this is just part of the cycle. So Avalon before 2020, they were growing adjusted funds from operations per share, which is my favorite metric, around 3%, 4%, 2%, so around 3 to 4%. Then they had the COVID stuff, they declined. And after that, a massive increase, 19% in 2022, 8.49% in 2023. Now in 2024, it's expected to be around 1.8%. Now, I don't see anything wrong here. I mean, this is just the way the cycle is. You have ups, you have down. You go up a lot, you have to go down a little bit, then you stabilize and you start growing again. And this is what's expected from Avalon. 2024 is expected to be the bottom for FFO per share growth of 1.8%. Then it's going to pick up to 5%, then to 10% in 2026. And because of the extended periods, then it's going to go down again to 8%, 4%, then 1%. This is just a cycle. So I don't really see anything wrong here. Yet if you see the way Avalon and the second one have been trading, I mean, it's trading at the same exact price it was sitting at in 2014. Now imagine how much rents are much higher than 2014. These apartment buildings in these areas, New York, California, and Florida and Texas, they're worth much more than they were in 2014. But these companies they have very bad sentiment. And I see an opportunity here from something that's pretty normal. Now, the reason why apartment REITs are my favorites, not just because they tend to grow FFO per share more than, triple net lease or something like realty income, but mainly because they don't really dilute stock a lot for them to grow the FFO. They grow it with the rent 2, 3, 4, 5% a year, 6%, sometimes 7%. They don't really have to dilute stock to do acquisitions like a lot of the triple net, REITs do. And this is Avalon's shares outstanding. They have been going up a little bit, but I mean, nothing crazy. They're pretty much still the same. I mean, so it's very little dilution. This is something I like very, very much. In terms of the dividend yield is pretty close to 4%. So this is a dividend that you will most likely get. I think dividend is safe. Most of the debt for Avalon is fixed at 4.2%, 3.5%, 2.9%. So it's very low interest rate, and nothing major is due every single year. And the dividend is very well covered. The payout ratio for Avalon is pretty close to 80% in terms of FFO per share. Now, in terms of the way I calculated the expected return for Avalon Bay Communities, I pretty much used the FFO per share that we have right now, and I put in that it's going to grow. I mean, I could look at the number. So I put in 993. This is the FFO per share right now, adjusted FFO per share. And I put in 5 years and around a 5% growth rate, which I believe is fair. I don't think it's going to go 10%. I don't think it's going to grow 8%. I think 5% is fair. So if we do have around a 5% average, which I believe is possible if you look at this one from 5 to 10, I think 5%. So if we use the 5%, we get around $12.67 of FFO per share. Now, if you look at the multiple, the stock right now is sitting at 17 times price to AFFO per share. It was trading at the same way it was like in 2020, much lower than ever traded at since 2014 on a multiple basis. Now, the mean was 22 times earnings. When we had low interest rates, it traded at 31 times earnings. I'm not betting on 0% interest rates. But once interest rates revert to 2%, 2.5%, pretty close to Jerome Powell's neutral rate, as eventually going to happen, I would expect the multiple to get back to around 22 times earnings. So if we take the number of $12.67 and we time it by 22 times earnings, this is $278 per share. The stock right now is sitting at $173. So we divide it by $173, we get around 61% on the upside over the next 5 years. This is excluding the 4% dividend. In total, with a slight better multiple expansion or some growth, I would say pretty close to 100% on the upside for Avalon over the next 5 years, or 15% CAGR every single year. But as I said, and I tell people in my own group, that these kind of companies, they are dead money for a while. So you might have other stocks like AI stocks or growth stocks go up, and these stocks might still be flat until interest rates come down. And we don't know when this is going to happen. It could be this year, could be next year, could be the year after. But if you have, I mean, the way I think about it, I'd rather have my cash in Avalon or something like the second one, getting 4.5%, pretty close to a 5% dividend, and such massive upside potential than just having it sitting in my account. And it's eventually going to play out. These stocks are eventually going to make parabolic moves, but I just don't know when. This is the thing. To me, they are kind of easy money stocks. Like, I know I'm going to get paid, but I just don't know when. And this is how I think about Avalon Bay Communities. And this is the second one, which I currently have a position in, and it hasn't been playing out well. I use the profits from Avalon to buy Mid-America, and I average a little bit on the stock. And this is Mid-America Apartment Communities sitting at $123. You can see it's a crazy chart. I mean, the stock shot up to like 210. The dividend yield went below 1% when we had 0% interest rate. I mean, it was absolutely insane. And now it's, again, just reverting back to the mean. I mean, it could still go a little bit lower, maybe 109, 110. I wouldn't be surprised. But this is Mid-America Apartment Communities. They are much more focused in the Sun Belt area where people are moving to. Georgia and Tennessee and, Florida and Texas and these states. You're familiar with them. This is where people are moving to. So these are very high growth areas. But again, in terms of earnings were not bad. They beat EPS by 6%. Pretty good beat. I was satisfied with that. But they have also things that I'm not satisfied with, and it's mainly the core AFFO per share. It was 220 in Q4 of 2022. Now it's 210, so it declined a little bit. In terms of the dividend payout ratio to AFFO, it's around 70%. So 70% is a low payout ratio for a REIT, and you still have 30% they can use to do acquisitions or to pay down the debt. And the debt, most of it is pretty safe, in my opinion, because it's locked in around the 3.6%. 89% of the debt is locked in at 3.6%, and the average, kind of year to maturity is around 6.8 years. So I'm not really concerned about the debt, and I think the dividend is safe for mid-America. In terms of guidance, they have guidance of a decline in NOI growth of around 1.3%. It's not the best, but this is not something that I was expecting. I was expecting flat to slight growth. I was not expecting a decline, but it's the same also with AFFO per share. They have it slightly lower than the analyst estimates. But again, this is, in my opinion, normal, just like what I said about Avalon. I think the mid-America apartment communities is the same thing. This is, cyclical. It used to grow around 20%, and then 9%, then it declined in 2020, then it grew 10% in 2021, then 21% in 2022. Of course, it's going to decline a little bit. This is just a cycle. Just like what happened in 2018, 2019, it declined in 2020. We had COVID, yes. But then it went up in 2021, 2022. 2023 was 7%, which was still good. 2024, it has to decline for it to grow around 3% again, 11%, 9%. So mid-America is eventually going to get back to the years of growth where they had in 2018 and 2019. And as I said with Avalon, mid-America, I also believe 2024 will be the worst year for them, the bottom in terms of sentiment, in terms of FFO per share, in terms of everything. And I think 2025 and beyond is going to look amazing for these companies. But it could play out before then, it could play out after that, which is why the dividend is important with these companies, because you get paid while you wait. The dividend for mid-America is pretty close to 4.6%, and the payout ratio, I think, was around 70%, we said. So it's a pretty safe dividend, in my opinion. And you also have a multiple expansion. The stock is sitting at 15 times AFFO per share, and the mean was 20 times. Now, I'm not saying it's going to go back to the highs of 33 times. But I think around, 15 times at the COVID low, I think this is extremely low for the company. And once we have, lower interest rates in the future, which is going to come, I would expect mid-America to get back around the 20 times of AFFO per share range. If it does get back to 20 times, you have massive upside on a multiple expansion, but you've also locked in around a 4.6% dividend. So these companies, as I said, I think they are easy money. I have to be careful with this word, because I just believe that if anyone buys them, you're eventually going to make money on them. But it might be frustrated for a little bit. You might watch other stocks rise while this stock is flat, and you wonder when it's going to go up. And likely when you sell it, it's going to go up after. This is what normally happens. So if you have something safe with a pretty decent dividend, high quality company that is eventually going to give you price appreciation, but you don't know when, I think Avalon and mid-America is amazing choices. And these were my two picks for February of 2024 for my two dividend stocks to consider. It was not financial advice. So thank you for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.